Disclaimer. This video is for educational and informational purposes only and should not be considered financial advice. Always conduct your own research and consult a qualified financial professional before making any investment decisions. Hello and welcome, everyone. Today we have a highly detailed, forensic breakdown of the Getty Images Q2 2026 financial crisis. As we dive into this data, keep in mind we are looking at the absolute anatomy of a distressed asset. We're talking about a company with a massive, globally recognized operating business that has suddenly seen its equity completely fall apart. We are going to examine the numbers, the debt, and exactly how a fundamentally profitable business devolved into a distressed equity stub.
Here is our roadmap for this explainer. We're doing an exhaustive metric-by-metric teardown. We'll start with the initial collapse, explore the core operating business, unpack the financials and those massive red flags, dive into the debt and governance traps, look at the market data, and finally model out the valuation and future scenarios. Let's get right to it.
Section 1. The Collapse of Getty Images. Market Shock and Core Thesis.
Our core thesis today is that Getty Images, trading under the ticker GETY, is now trading purely as a distressed equity stub, and the sheer velocity of this drop proves it. On August 11th, Getty closed at exactly 29 cents a share. That was a brutal drop of nearly 16 cents or 35.75% for the day. To put that into perspective, the volume was staggering, between 16 and 16.1 million shares traded, representing roughly 3.8% of their entire 421 million shares outstanding. Looking at the intraday action, it opened at 32 cents, hit a high of just under 38 cents, and crashed to a panic low of 27.8 cents. This plunged their market cap to just over 120.7 million on finance feeds, or roughly 122.1 million calculated at that 29-cent close. So you have to ask, what was the catalyst? It wasn't just a simple Q2 loss. It was extreme free cash flow burn, formally withdrawn guidance, a strategic financing review, and critically, going concern risk. And notice the after-hours action? It offered barely a blip, a meager bounce to about 29.3 cents, up 2.6%, with some finance feeds actually quoting it even lower at 28.7 cents. There was zero strong reversal here.
Let's look at this completely impartially. What are the bulls and bears seeing right now? The bulls can absolutely still argue that the core business is alive. They generate positive adjusted EBITDA. They own a massive content collection, 625 million images and 39 million videos. Plus, in June, they signed a multi-year display agreement with OpenAI. That's real, tangible intellectual property value. But flip over to the bear side and look at what the market correctly discounted: existential balance sheet survival risk. They suffered a devastating $110.9 million warrant litigation payment, which led to a negative $122.6 million Q2 free cash flow print. And, as we'll dive into next, their user retention is quite frankly collapsing.
Moving to Section 2, the core operating business, the paradox of profitable operations.
This operational data perfectly highlights Getty's central paradox. It is a functioning, asset-rich business entirely overshadowed by a toxic capital structure. Total Q2 revenue came in at $229.1 million, which was down 2.5% year over year. For the first half of the year, revenue was $455.7 million, down just 0.7%. Digging into the segments, creative revenue, which makes up 55.6% of total revenue, dropped 2.6% to $127.4 million. But here's a bright spot. Editorial revenue, representing 42.1% of the pie, actually grew 9.2% to $96.5 million. Other revenue dropped sharply by 66.7% to $5.2 million. We also saw annual subscription revenue climb to 58.8% of total revenue, up from 53.5%. But folks, here is where the economic moat is severely cracking. Last 12 months, purchasing customers dropped 10% to 636,000. Even worse, active annual subscribers, the lifeblood of their recurring revenue, fell a massive 25.2%, down to just 240,000. Subscriber revenue retention fell 500 basis points, dropping from 93.4% down to 88.4%. Paid downloads also fell 2.8% to 90 million. Now, they did grow their content collection by 5.7% to 625 million images and 11.7% to 39 million videos, but those underlying user KPIs are trending heavily in the wrong direction.
Now look at this P&L paradox. Getty still managed to generate $32.4 million in Q2 income from operations, representing a 14.1% operating margin. For the first half, operating income was $63.9 million. Adjusted EBITDA was a very real $62.3 million in Q2 with a 27.2% margin. For the first half, that adjusted EBITDA was nearly $123.9 million. If you look at adjusted EBITDA less CapEx, they did $48.4 million in Q2 and $94 million for the half year. But then you look at the bottom line. GAAP net loss was almost $85.8 million in Q2 and $90.2 million for the half year. That translates to a net loss specifically to Getty's stockholders of $86.3 million or negative 21 cents per share for Q2 and a $90.4 million loss or negative 22 cents for the half year. To give you some context, look at the fiscal year 2025 anchor. Back in 2025, they did $320.9 million in adjusted EBITDA at a 32.7% margin. Today, they are generating decent operational cash, but it is being utterly consumed before it ever reaches the equity holders.
Section 3. Financials and Red Flags. Let's conduct the autopsy of Q2.
To truly understand why a company making over $62 million in adjusted EBITDA reported a massive net loss, we have to look at exactly where the cash is bleeding out. Q2 operating cash flow was negative $108.7 million, and half-year was negative $68.7 million. Q2 free cash flow was an even worse negative $122.6 million, dragging the half-year free cash flow to negative $98.6 million. This severe cash burn was the direct result of a devastating $110.9 million warrant litigation and interest payment made right in the middle of Q2. That single payment absolutely gutted them, leaving only $51.6 million in unrestricted cash. Yes, the balance sheet shows $646.3 million in restricted cash, but remember, that was tied up mostly in merger escrow mechanics. So at the end of Q2, their total usable liquidity was just $81.6 million. That's their cash plus a $30 million remaining revolver. And here's the scariest part, they still have $99.5 million sitting in litigation reserves. That is a massive ongoing risk for a company with total stockholders' equity of $450.7 million, or a book value of roughly $1.07 per share. And keep in mind, that equity is heavily propped up by huge balance sheet assets, including $1.5 billion in goodwill and $407 million in intangibles.
Now let's walk through the exact expense distortions on the income statement, because below the operating line, things get completely wild. Cost of revenue, excluding depreciation, was $68.3 million, leaving a very healthy gross profit before D&A of almost $160.8 million. From there, we subtract $101.5 million in SG&A, $15.9 million for depreciation and amortization, and a $4.3 million loss on litigation. But here's where it goes off the rails. Interest expense was a whopping $57.3 million. That completely swallowed their operating income. Then, despite logging a relatively small pre-tax loss of just $12.4 million, they recorded an absolutely staggering tax expense of $73.4 million. The company explicitly stated that the Q2 net loss was driven by a massive year-over-year increase in tax expense. These distortions are mathematically obliterating the bottom line. Synthesizing these disclosures, we arrive at 5 major footnote and accounting red flags. Number 1, and this is the absolute biggest deal, management formally disclosed substantial doubt about the company's ability to continue as a going concern for 1 year. In Wall Street terminology, that is a massive bankruptcy warning. Number 2, liquidity is dangerously tight. That $81.6 million in Q2 liquidity included $30 million left on a revolver, which they fully drew down in July. Number 3, the relentless litigation drain. They just paid $110.9 million, and another $99.5 million sits in reserve. Number 4, as we just saw, tax and interest distortions are exceeding operating income. And number 5, they completely and formally withdrew all full-year financial guidance as they explore strategic financing alternatives.
How did we get to this crisis point so fast? Let's trace the catalyst calendar chronologically. Back in June, things seemed optimistic. They signed the OpenAI agreement. But crucially, that same month, the UK's Competition and Markets Authority required Getty to divest Shutterstock's editorial business as a condition for their proposed merger. Getty's board flatly rejected that divestiture. So, by July, the massive $3.7 billion Shutterstock merger, which amazingly the US DOJ had actually approved, was formally terminated. Also in July, cash got so tight they drew down that final $30 million revolver. Then on August 10th, Q2 earnings drop, exposing the terrifying cash bleed, and they announced they've engaged Guggenheim Securities for strategic financing. Looking near-term, they face huge options expirations on August 21st and September 18th, alongside ongoing litigation updates and a very real risk of falling out of sub-$1 NYSE exchange compliance.
Section 4. Debt, Governance, and Equity. Welcome to the control trap.
If you're wondering how a company making almost $230 million a quarter in revenue has a microscopic $120 million market cap, here is your answer: the debt stack. Total face amount debt at the end of Q2 was a staggering $2.068 billion. Current liabilities stood at $1.16 billion, and net long-term debt was $1.33 billion. Now, after the Shutterstock merger fell apart, they did redeem $628.4 million of merger notes at par value out of escrow. They also had $120 million drawn on the revolver at Q2, plus that extra $30 million drawn in July. So if we adjust for all that, pro forma gross debt sits at roughly $1.47 billion, with pro forma net debt at about $1.389 billion. That debt entirely dwarfs the equity. If you look at the enterprise value to last 12 months revenue on a pro forma basis, the multiple looks incredibly cheap at 1.55x, down from 2.19x on a face debt basis. But it's only optically cheap because that massive mountain of debt is eating up virtually all of the company's underlying value.
Furthermore, as a minority shareholder, you have absolutely zero say in how this debt gets restructured. This is the ultimate control trap. The Getty family stockholders own 45.7% of the voting power. GETY Images Holdings, a co-investor, owns 27.5%. Collectively, that is roughly 74% of the voting control securely locked up by insiders. The minority and public float hold only 26.8%. You are essentially a powerless passenger on a ship steered entirely by strategic holders and creditors.
So what does being a passenger actually mean right now? It means you're facing multiple structural traps. There's the debt trap. Any slight drop in enterprise value entirely wipes out your thin equity slice. The litigation trap. That $99.5 million reserve is almost identical in size to the entire market cap of the company. The guidance trap. Without forward numbers, valuation relies on highly uncertain financing, not actual business forecasts. And the compliance trap. Trading at 29 cents creates severe NYSE listing and reverse split risks. But the most terrifying is the dilution overhang. Let's just do the math. If Guggenheim manages to secure a lifeline and raises just $100 million at the current 29-cent price, Getty would have to issue approximately 345 million new shares. Against a current base of 421 million shares outstanding, you are looking at diluting current holders by roughly 82%.
Section 5. Market data and positioning. Let's break down the short mechanics and options dynamics.
Let's kill a popular myth right now. This 35.8% collapse was absolutely not a short squeeze setup. Look at the data from July 31st. Shares short were 9.28 million, an 8.89% increase, sure, but depending on the methodology you use, that's only 2.53% to 7.91% of the float. While the borrow fee was a bit elevated at 11.87% on August 10th, there were still 3.3 million shares readily available to borrow. And crucially, based on August 11's massive 16 million share volume, the mechanical days to cover was a tiny 0.58 days. That means it would take barely half a trading session for all short sellers to buy back their entire positions. The market repriced Getty based on fundamental liquidity and going concern fears, not because of aggressive, trappable short selling.
The options market shows us just how technically broken Getty stock currently is. Let's look at the upcoming August 21st options chain. The lowest listed strike is 50 cents. There's a massive wall of over 16,000 puts sitting at that 50-cent strike, which are now deep in the money. Meanwhile, you have nearly 9,400 calls at the $1 strike, which happens to be max pain, the theoretical price where option buyers lose the most money. Further up, you have over 4,400 calls at the $1.50 strike. For September 18th, max pain drops to 50 cents, with very light open interest across the board. The options chain is essentially useless right now for creating a floor, or bullish pinning, because the actual stock price is trapped in the 20-cent range, far below the lowest available strikes. The stock has to fundamentally reclaim 50 cents before options positioning even begins to matter again.
Finally, Section 6, Valuation and Future Scenarios. What is the ultimate prognosis?
What is the prognosis for a stock that has lost over a third of its value in a single day, completely withdrawn its guidance, and literally flashed a going concern warning? Everything rests on this one ultimate existential question. Can Getty Images, with the help of Guggenheim, secure strategic refinancing without wiping out or massively diluting the common shareholders? Remember, a hard discounted cash flow valuation is totally unavailable right now. It cannot be responsibly built without management guidance and with unresolved litigation hanging over the balance sheet. So we have to rely on technical levels and scenario probabilities.
Here is the technical bounce map, and it is a very steep climb. The absolute critical level is holding that intraday panic low of 27.8 cents. If that breaks, the distressed breakdown targets 20 cents, and eventually the 10-cent equity impairment zone, which signals pure restructuring and wipeout fear. For any bullish case to take hold from the 29-cent regular close, the stock must first reclaim the intraday open at 32 cents, break past the failed bounce high of 37.8 cents, and ultimately reclaim 50 cents for options repair and September max pain. Reaching $1, the August max pain, and the critical level for NYC compliance and institutional repair is an incredibly long road from here.
We'll leave you with this final, high-uncertainty valuation scenario framework. We assign a 60% probability to the bear case, valuing the stock at just 5 cents, assuming financing severely dilutes the equity, liquidity weakens further, and the stock stays sub $1. The base case gets a 30% probability at 30 cents, assuming financing just buys them time, EBITDA stabilizes, and the equity survives as a distressed asset. The bull case is a very slim 10% probability at $1.20, requiring a clean refinance without massive dilution, finally allowing that open AI and AI licensing upside to benefit shareholders. Our scenario-weighted fair value lands at roughly 25 cents a share. To put the leverage into perspective, at a 5x enterprise value to EBITDA multiple based on their $306.7 million trailing EBITDA, shares are theoretically worth about 34 cents. But at a 4.5x multiple, the equity is mathematically zeroed out. So is that slim 10% chance of an AI-driven turnaround worth the 60% risk of total impairment? That is the definitive question you have to ask yourself. Thank you so much for joining this explainer, and we will see you next time.